So in today's lecture, we will cover corporate performance, governance, and business ethics. In this reading, there are no practice problems and no real examples that you can work through, just examples that you have to read. And what I have done here is taken a lot of extracts from the curriculum, and I'll be doing a lot of reading. So if you are wondering what the value addition of this class or this video would be, one value would be that we are highlighting the most important aspects of the reading. And the other that I think is perhaps more useful is if you have a very busy schedule, this reading can essentially be treated like an audio lecture because there isn't that much work, no calculations. So actually on your commute to work, you can listen to the audio and get through the reading. There are three basic segments in the reading. The first has to do with stakeholders and corporate governance. The second is agency theory, and finally ethics and strategy. Let's start with stakeholders and corporate governance. A lot of material that you will see here is material that you have covered in previous levels. But the difference at this level is that we are going to get into some philosophies of ethics, so to speak, the thought process that goes into the sorts of corporate governance structures that we have talked about at earlier levels. But let's start with the basics, and this is figure 1 from the curriculum. When we talk about a corporation or a company, we need to be aware of all the stakeholders. And once we are aware of the stakeholders, then we can talk about corporate governance. But the first part of this reading puts a lot of emphasis on understanding stakeholders. Broadly speaking, if you have a company in the middle, the company will have some external stakeholders and internal stakeholders. And all stakeholders make some contribution to the company and then receive some, what the curriculum calls inducements. These might be compensation in some form, or they receive something from the company. Let's just go through the internal stakeholders. What do stockholders do? What do they contribute? They contribute capital. And what do they get in return? They get a return on capital. What do employees do? They work for a company, provide their labor, and they get compensation. Managers, here we are referring to senior managers, so they are in a sense employees, and a lot of senior managers might also be stockholders. And then you have board members who represent the stockholders. On the external stakeholder side, we have customers. Customers buy product from the company and pay the company for the product. Suppliers supply product to the company and receive money. Creditors are in essence also suppliers. They are suppliers of credit. Governments provide the structure, laws, regulations, infrastructure, and so on, and in return they receive taxes. Unions, in a sense, represent the employees, and unions obviously have an important role to play. So unions will be bargaining for better salaries, better work conditions, and so on. You will have local communities. Obviously, these are also stakeholders. If you have a large chemical factory, the local community is potentially impacted by the pollution. The benefit to the community is employment. And then obviously general public is impacted in the sense that overall economies are impacted. There can be pollution issues or other favorable externalities that are caused by companies. So it is a complex web that we need to understand. All stakeholders in an exchange, so all these stakeholders are in an exchange relationship. This is just emphasizing the fact that all these stakeholders have a give and take relationship of some sort. A company must consider stakeholder claims when formulating strategy. So whenever a strategy is being created, you need to understand what the impact is on customers, suppliers, employees, the providers of capital, and so on. A good way of doing that analysis is called a stakeholder impact analysis, and I think this is fairly testable. Stakeholders might have conflicting demands. Why? You might have providers of capital who want the company to be as profitable as possible or provide high returns, whereas you might have suppliers who are interested in supplying their products at a very high price. So do you think a supplier wants the company he is supplying to be extremely profitable? Partly yes, but not at the expense of the supplier. Obviously, the supplier would want his own profitability to be high. But high level, there are conflicting demands between stakeholders. Sometimes demands might be aligned, sometimes they will be conflicting. So what's a management supposed to do? In the stakeholder impact analysis at a high level, management should identify the most important stakeholders and pursue strategies to address their needs. Obviously, you can't keep everyone happy, so you identify the most important stakeholders and do the best to at least keep those stakeholders happy. More formally, here are the 5 steps. You identify the stakeholders, which to an extent we've done. Identify the stakeholders' interests and concerns. As a result, identify what claims stakeholders are likely to make on the organization. Identify the stakeholders who are most important from the organization's perspective. And then once you've understood that, then you identify the resulting strategies and the strategic challenges that you must address. Now, across many companies and many geographies, which stakeholders do you think are typically the most important? Typically, the most important are customers, employees, and stockholders. If customers don't buy your product, you're not going anywhere. If employees are not happily contributing to the company, that's a big problem. And if stockholders don't provide what's called the risk capital, then that is a huge issue also. Now, obviously, in some companies, other stakeholders might also have an important role to play, but by and large, these 3 always have a high position in the stakeholder impact analysis. The curriculum doesn't get into too much detail, so as long as you understand these basic points, you should be in good shape. There is a unique role for stockholders. So stockholders are one of the stakeholders. And why are they unique? These are the people, or these are the stakeholders who supply risk capital. And the point is fairly straightforward. No company can be successful until somebody invests in that company. And whoever is investing as a stockholder is taking the risk of losing all their money. And until somebody is taking that risk, a company cannot be formed and it cannot grow beyond a certain level. Obviously, once a company has some basis, only then will you get debt-based financing. So that puts stockholders in a very central position. What about employees? Increasingly, employees are becoming shareholders through employee stock option plans or stock purchase plans and so on. The objective of maximizing value is becoming increasingly important. By and large, finance theory and economic theory says that the purpose of an organization should be to maximize value. Obviously, there could be a conflict between what managers want and what shareholders want, but as long as more managers and employees are becoming shareholders, then that objective is becoming aligned and becoming even more important. One of the items that is beneficial to most of the stakeholders is profitability and profit growth. The reason is, if a company is profitable and those profits are growing, then do the employees benefit? Obviously, employees benefit. Do stockholders benefit? They do. Customers benefit to an extent that obviously a customer would like to buy from a company that is successful and growing. Obviously, customers would not want the company to be profitable at their expense, but still a customer would like to interact with a profitable company because that tells the customer that this company is going to be around for a while. So by and large, profitability and profit growth, at least in the long run, is good for most stakeholders. Possibly there are some stakeholders such as suppliers for whom this might not be objective, and I don't think it's a huge big point, but by and large, just understand that profitability and profit growth is important. A metric that is emphasized in the curriculum is return on invested capital, or ROIC. This is a good measure of profitability. It's telling you how much you invest and how much return, net income on the money invested. So there are times when managers pursue illegal strategies to maximize profitability. Given the importance of profitability, there are times where unscrupulous managers might act in ways that are unethical. And the curriculum gives an interesting example. A few years ago, senior executives from Boeing were caught stealing proprietary material from a competitor, Lockheed Martin. There was this very high value contract with the government, with the Air Force, and it was found out that Boeing was using proprietary material that actually belonged to Lockheed Martin. Maybe it was their proposal or some information from the competitor. So that was a huge issue. And then Boeing had made a lucrative job offer to somebody in the government who was evaluating the proposal, and this person in the government had an offer to come work for Boeing after the contract was over. Now, do you think that might bias the person in the government in favor of Boeing? Probably. So examples like this happen all over the world where to maximize profitability, managers might act in unethical ways. Now, in case you are wondering, if the benefit is going to the company in terms of high profitability, why would a manager act unethically? And the reason often is that when companies do well, senior managers' compensations are heavily tied to the profitability and growth of companies. So by trying to have better profitability for their companies, they are also enriching themselves. And we'll see more of this later. Moving now to agency theory, and you have seen this at earlier levels. Agency theory looks at problems that arise when authority is delegated. And the classic example that we've looked at is in the manager-shareholder relationship. What do shareholders do? They delegate authority to managers. And when we talk about agency theory at level 1 and level 2, that's the context we've generally taken, where the principal is the shareholder or stockholder and the agent is senior management. But agency theory can be extended to the sense that the CEO is an agent where the principal is the other board of directors. But for the CEO, we also have this relationship where the CEO might have business unit heads. So you have these various business units. Is there an agency relationship between the business unit and the CEO? So between the business unit head and the CEO, you will also have agency problems. In fact, you can have agency problems all the way through the organization. And agency theory does deal with these multiple layers or multiple relationships. The agency problem arises when goals are different and there is information asymmetry. And the classic case that we looked at earlier is what is the goal that shareholders have? Their goal is to maximize the value of the firm, maximize the value of the stock. What might the goal of the senior management be? Higher salaries, higher bonuses, etc., etc. So there is a conflict. Is there asymmetric information? There is. Management knows a lot more about what's going on relative to the stockholders or board of directors. So there is an opportunity for management to do things that are not right. So what mechanisms can we put in place to minimize these problems? The shareholders elect a board of directors, and the board of directors are supposed to oversee what the managers are doing. We don't get into details at level 3, but at level 1 and 2, we talk in detail about what must the board of directors do in order to effectively oversee the managers. And that's where all these corporate governance structures and rules come into play. We have external audits, we have internal audits. So all these are mechanisms of trying to reduce the information asymmetry and try to reduce the agency problem. However, some executives will still exploit the information asymmetries because the information asymmetries don't go away. Here is a classic problem depicted through figure 2 in the curriculum. The problem has to do with the fact that generally senior executives at larger companies get paid more. If you are the CEO of a $3 million company, you will have a certain salary. If you are the CEO of a $50 million company, your salary will be much more. So there might be an incentive for a CEO to build an empire, to expand, to bring on new business units at possibly the expense of profitability, because clearly as a company keeps expanding, it will get into projects where the value add is diminishing. And the way that's depicted here is, if we look at different rates of revenue growth, if we are at level G1, so at this rate of revenue growth, let's say this is 2%, the profitability level is here at pi 1. When as growth rate is increased from 2% to 3%, is that moving in the right direction? Because what we are looking at on the y-axis is long-run profitability. Is it okay to increase revenue growth if profitability is going up? It makes sense. So there is some optimal growth rate at which the long-run profitability is maximized. So that's denoted by pi star. Up to this level, it makes sense to keep growing. But then what happens after this level? After this level, the only thing that grows is the executive compensation. Or actually, I should not quite put it that way. As you go beyond G star, what is going on? What is happening is the company is adding new projects, which might still be profitable, but not optimal. So now the profitability of the organization is declining. So what will happen to the value of the company or share prices? They will start coming down. But if the company is becoming larger, the CEO and senior executive salaries will go up. So here is a classic agency problem that might be very hard to detect. And it is something we need to be aware of. What growth rate will be favored by an empire building CEO? He is going to favor a higher growth rate. Is this optimal for shareholders? Obviously not, because profitability is coming down. All right, as promised earlier, I will be doing a fair amount of reading here, and this is just to help you identify the most important parts and so that you can listen to the audio and effectively have this reading covered. Just how serious agency problems can be was emphasized in the early 2000s when a series of scandals swept through the corporate world, many of which could be attributed to self-interest seeking by senior executives and a failure of corporate governance mechanisms to hold the excess of those executives in check. Now, interestingly for me, I was doing my MBA in the late 90s. And many of the companies that we will see here in the late 90s, these were companies that we modeled. These were companies where we looked at their case studies, we thought about buying their stocks, and then after I finished my MBA, then I saw the sorts of things you're going to look at. So between 2001 and 2004, accounting scandals unfolded at a number of major corporations, including Enron. Enron was hugely popular in the 90s and had exponential growth. And lots of finance textbooks about ethics and corporate governance love to talk about Enron, as you've seen at earlier levels. Other companies were WorldCom, Tyco, so these were huge companies, Computer Associates, HealthSouth, etc., etc. In Italy, there was a major food company called Parmalat. At Enron, some 27 billion in debt was hidden from shareholders, employees, and regulators in special partnerships that were kept off the balance sheet. And you might recall studying this at level 1 in FRA. At Parmalat, managers apparently invented some 8 to 12 billion in assets to shore up the company's balance sheet, assets that never existed. So these are amazing facts and figures. And this list goes on. Now, why were senior managers doing this? If you look at the sort of compensation that senior executives at Enron got based on share price appreciation, based on profitability, those salaries are incredibly high. And how could they sustain those salaries? By presenting a picture that the company is doing well, always thinking that in the long run, they, I think, convince themselves that the company will indeed start doing well from next year and next year and next year, but it doesn't always work out that way. Confronted with agency problems, the challenge for principals, who are the principals in this case? These are the shareholders, is to, number one, shape the behavior of agents so that they act in accordance with the goals set by the principals. Number two, reduce information asymmetry between agents and principals. And 3, develop mechanisms for removing agents who do not act in accordance with the goals of principles and removing agents who basically mislead the principles. Principles try to deal with these challenges through a series of governance mechanisms. Now, fortunately for us, we have already studied those governance mechanisms at earlier levels, so we are not going to see them at level 3. Obviously, you need to be aware of them. Next section is ethics and strategy. The term ethics refers to accepted principles of right or wrong that govern the conduct of a person, the members of a profession, or the actions of an organization. Now, as a high-level remark, what you are going to see over the next few slides is mostly philosophy. Within philosophy, one element or one area within philosophy is the study of ethics. And I have taken a philosophy course in college, and a lot of that material I'm seeing here in the context of how businesses should operate. Some of you might have taken courses in business ethics in college, and you will probably find that material over here. In our society, many accepted principles of right and wrong are not only universally recognized, but also codified into law. In the business arena, there are laws governing product liability, contracts and breaches of contract, the protection of intellectual property, competitive behavior, and the selling of securities. Not only is it unethical to break these laws, it is illegal. In developed countries, if I were to express this as a picture, what you might notice is that if you draw a picture of what is illegal, generally there is a fairly high overlap between what is illegal and what is unethical. Generally, you would want these two to go together. What is unethical should ideally be illegal, but is that always the case? It's unfortunately not always the case. So the question comes up, if something is not illegal but it is unethical, what should companies do? All right, and a lot of what follows is trying to deal or grapple with that somewhat philosophical question. The curriculum gives a nice example that I partially reproduce, which is the Nike sweatshop example. And very simplistically, the situation is this. The case study actually is given right here. The first part, which I have not copied, gives an overview of Nike. Everybody knows what Nike does. Everybody knows the Nike swoosh. The point is that Nike, at some point in the past, had this factory or facility in Vietnam. Nike, actually, their business strategy revolves around, they do the design, they do the marketing, but all the production, manufacturing is outsourced to low-cost countries. In Nike's case, they outsource to the lowest of the low-cost countries. A lot of their work happened in Vietnam. Now, the work that happened in their what were called sweatshops in Vietnam, their people were working in substandard environments. The total hourly wage or daily wage was extremely small. I think it was something like $2.50 an hour, and the work conditions were dangerous. So, as you might expect, there was an outcry. Why should a global company that is making so much money and selling such a high-end product, why should they be exploiting people in Vietnam? So there were protests in colleges, universities. Some of the major client base for companies like Nike are in colleges, universities in the West. So there were student protests, and then Nike had to step back. So this is the last part of that case study, which I think is worth reading together. These exposés, the exposés being the revelation of the fact that there are sweatshops in Vietnam where conditions are poor, salaries are very low. So these exposés surrounding Nike's use of subcontractors forced the company to re-examine its policies, realizing that its subcontracting policies were perceived as unethical. Now, notice this is a very important word. So they were perceived as unethical. Nike's management took a number of steps, including establishing a code of conduct for Nike's subcontractors and setting up a scheme whereby all subcontractors would be monitored annually by independent auditors. Nike's code of conduct required that all employees at footwear factories be at least 18 years old, and the exposure to potential toxic material would not exceed the permissible exposure limits established by the US Occupational Safety and Health Administration, which is generally called OSHA, for workers in the United States. So in other words, they took the same standards from the US and applied them to their contractors in other parts of the world. In short, Nike concluded that behaving ethically required going beyond the requirements of the law. It required the establishment and enforcement of rules that adhere to accepted moral principles of right and wrong. So you might call this a moral decision, or you might call it a business decision, but in essence, they moved in the right direction. So what are some ethical issues in strategy? The ethical issues that strategic managers confront cover a wide range of topics, but most are due to a potential conflict between the goals of the enterprise or the goals of individual managers and the fundamental rights of important stakeholders, including stockholders, customers, employees, suppliers, competitors, communities, and the general public. Stakeholders have basic rights that should be respected, and it is unethical to violate those rights. Which stakeholders were being abused in the Nike scenario? The employees were being abused. Now, what ethics or the material we are looking at here tells us that a company should recognize those fundamental human rights, even though what Nike was doing was legal, but it was unethical because it was violating human rights. So we need to take that into account. So employees have rights, that was obvious. What sort of rights should suppliers have? The basic right would be that if a large company creates a contract with a supplier, it should honor that contract. The curriculum gives an interesting little example. I forget the exact names of the companies, but you might have a situation where you have a very large customer and a small supplier, where for the supplier, the customer is the only major customer. So a contract is drafted and agreed upon, and then once the supplier sets up the factory to supply, the customer then cuts back and says, I'll only pay you 20% because I've had a bad year, and so on. Why might a big customer do this? Because the big customer knows that the supplier has committed and the supplier has nowhere else to go, so the big customer can exploit, right? Is that illegal? Maybe the customer can do it in a way that's not illegal, and it might not be in the supplier's interest to pursue it through the courts. In most countries, that actually will become even more problematic. So clearly, companies can exploit suppliers, and that would be unethical, even though it might not be illegal in many countries. What about rights of competitors? Does that make sense? The rights of customers basically means, I'll give you a simple example. When two teams are playing, right, it is competition, and obviously both teams need to follow agreed upon rules. Sometimes the rules are explicit, sometimes they are implicit, but even in competition, if a company starts acting unethically, then that is a violation of a basic right of your competitor. And with the community, obviously, this is straightforward. You have situations, at least in our country, where you can have chemical companies that are dumping chemicals in the rivers. Right? Clearly, that's a violation of the rights of the community, even though there might not be any laws that are prohibiting that, or in our country, probably the law exists, but nobody enforces that law. All right. Those who take the stakeholder view of business ethics often argue that it is in the enlightened self-interest of managers to behave in an ethical manner that recognizes and respects the fundamental rights of stakeholders, because doing so will ensure the support of stakeholders and thus ultimately benefit the firm and its managers. Others go beyond this instrumental approach to ethics to argue that in many cases acting ethically is simply the right thing to do. They argue that businesses need to recognize their noblesse oblige and give something back to the society that made their success possible. Noblesse oblige is a French term that refers to honorable and benevolent behavior that is considered the responsibility of people of high or noble birth. In a business setting, it is taken to mean benevolent behavior that is the moral responsibility of successful enterprises. So to summarize this point, successful companies have been successful because of the community and the environment that they are in. They are successful because customers have bought from them, suppliers have supplied to them, and the community has allowed them to prosper. So therefore, it is almost a moral duty or a noble thing to give back to society. And this has given birth to several of these social responsibility programs and social initiatives that you will see at several companies. Now, whether they are sincere or not is a question mark, but at least companies try to have some sort of give back to the society programs. Unethical behavior often arises in a corporate setting when managers decide to put the attainment of their own personal goals or the goals of the enterprise above the fundamental rights of one or more stakeholder groups. In other words, unethical behavior may arise from agency problems. The most common examples of such behavior involve self-dealing. And what do you think self-dealing means? Self-dealing is where managers use corporate money to enrich themselves. And how can that happen? When senior managers take excessive salaries, and that there are several examples given in the curriculum where senior managers have been paying themselves excessive salaries despite the poor performance of the company. So that's self-dealing, taking company money to enrich oneself. Now, that might not always be illegal in the sense that if a senior manager has convinced a friendly board of directors to give him a huge raise, nothing illegal about that, but it is still a self-serving or self-dealing issue. So other examples include information manipulation, anti-competitive behavior, opportunistic exploitation of other players in the value chain in which the firm is embedded, and this includes suppliers, complement providers, distributors, the maintenance of substantial working conditions, environmental degradation, and corruption. So these are just some examples of unethical behavior. From an exam perspective, it's important to understand the roots of unethical behavior, and this connects with something you saw at level 1 FRA, where you studied the fraud triangle. So does anybody recall what you saw there? Yeah, there is a motivation to do something wrong.
Then you rationalize it.
There is an environment where you can rationalize, and there is a opportunity to do something wrong. Now, that's pretty good. Those same concepts are repeated over here, and then a few more are added. Why do some managers behave unethically? What motivates them to engage in actions that violate accepted principles of right and wrong, trample on the rights of one or more stakeholder groups, or simply break the law? While there is no simple answer to this question, a few generalizations can be made. The first one is that business ethics cannot be divorced from personal ethics. The way you can look at this is, if somebody is not ethical in a personal setting, then obviously when he has an official position at a company, chances are that that company will also not be acting ethically. Second, sometimes business people act unethically simply because they fail to ask the relevant question: is this decision or action ethical? And I would say that finance textbooks and economic textbooks are often to blame for this. If you look back at capital budgeting lessons that you've learned, how do you figure out whether to do a project or not? So you read these long lectures, readings on capital budgeting. What do you study there? You look at NPV, you look at IRR. So essentially your analysis is almost always economic. That's the way most managers are trained to think. But what the point being made here is, when you do an analysis, do you also think about whether that project is ethical or not? Very often people don't even consider that. So do you think that might lead to some behavior that is not ethical without even knowing that it is not ethical? It can happen. So that's an important point. Another point is sometimes organizations de-emphasize business ethics and consider only economic factors. So this actually connects with what I just said, and all of us have seen that. 4, there is often pressure to meet performance goals, and you saw this explicitly at level 1 in the reading that I just alluded to. If leaders are unethical, what is the likelihood that subordinates will act ethically? Very low. The curriculum gives a good example of Kenneth Lay, who was the CEO of Enron in the late 90s. Now, he would talk about ethics. He would refer to Enron's code of ethics, code of conduct, but himself act unethically. Now, if he is acting unethically, what cue is he sending to his management? Obviously, his immediate subordinates who are watching the boss act unethically will also act unethically. Now, if you look at our own country, any place, any government officer that you go to, and I've experienced this personally, you ask him why he's not doing the right thing, he will always point up. So he will say, my boss does it, whose boss does it, so they keep passing the buck, and all the bucks seem to just head in one direction. All right. So the next point is different philosophical approaches to ethics. And here what we are going to talk about is essentially philosophy. So there are different thoughts of philosophies around approaches to ethics. The first one is the Friedman doctrine. So we will talk about this first. In 1970, Milton Friedman wrote an article that has since become a classic case that business ethics scholars outline only to then tear down. Now, what we'll notice here is it's an interesting case, but scholars often reference this and then point out the issues. But I think that there is actually some good points that Friedman makes. Friedman's basic position is that only social responsibility of businesses is to increase profits as long as the company stays within the rules of law. He explicitly rejects the idea that business should undertake social expenditures beyond those mandated by the law and required for the efficient running of a business. So his point is a business should be making money and a business should follow the rules. It's the responsibility of the government to make the right rules. And if you think about it, we'll see the criticisms later, but that's how most companies do operate. So I think there is a lot of power behind what he is saying. So, for example, his argument suggests that improving working conditions beyond the level required by the law and necessary to maximize employee productivity will reduce profits and is therefore not appropriate. His belief is that a firm should maximize its profits because that is the way to maximize the returns that accrue to the owners of the firm, its stockholders. If stockholders then want to make the proceeds, wish to make the proceeds to make social investments, that is their right, according to Friedman, but managers of the firm should not make that decision for them. So sounds fairly logical. But what is the counter argument? The counter argument is that how does this work in a country like Pakistan where laws around pollution, employee health and safety, product safety either don't exist or are not enforced, right? So if a large company dumps chemicals in the river or has a huge amount of pollution with clearly immense negative impact on the society, or a company is manufacturing medicines that have problems in them, then what do we do? The point is that you might find countries where the law does not exist, right? For example, if we go back to the Nike case, let's say that the sweatshop in Vietnam was perfectly legitimate according to Vietnamese law, right? So according to Milton Friedman, then it would be perfectly okay to go and have that sweatshop even though people's rights were being violated. So the question is that morally okay? Obviously, it is a question to be asked, and these are the sorts of questions we need to ask. I have just made, I guess, a small addition saying that sometimes you might have the law on paper, but it is clearly not implemented, and there is no attempt to implement. Then what happens? right? You will then also have companies that effectively then violate the law. But in any case, from an exam perspective, what do you need to know? You need to know the basic point that Milton Friedman made, that essentially companies should just follow the law and maximize profits, and then shareholders become richer, and then it's the prerogative of the shareholders to do good works if they want to. The company should not decide on the behalf of the shareholders what charity to give. That's the point. And then the counter argument is that then that allows for cases like the Nike sweatshop in Vietnam. All right, moving on. We will now talk about the utilitarian philosophy on this slide, and Kantian will come on the next. So utilitarian approaches to ethics hold that the moral worth of actions or practices is determined by their consequences. An action is judged to be desirable if it leads to the best possible balance of good consequences over bad consequences. Utilitarianism is committed to the maximization of good and the minimization of harm. It recognizes that actions have multiple consequences, some of which are good in a social sense and some of which are harmful. As a philosophy for business ethics, it focuses attention on the need to carefully weigh all of the social benefits and costs of a business action and to pursue only those actions where the benefits outweigh the costs. The best decisions from a utilitarian perspective are those that produce the greatest good for the greatest number of people. So that is the basic thought process. I'll just summarize that if a company does something that hurts a few people but benefits a lot, in other words, the overall good or overall benefit is more than the harm, then go for it. So in a sense, this is what has given birth to a cost-benefit analysis. And the cost-benefit analysis here is not just pure dollars and cents, but it takes a much broader perspective. So let's try to apply this. If we have two projects that we are considering, one is to build an oil rig in Alaska, and the other is a deforestation project in Pakistan. So if you're doing oil rig in Alaska, what sort of a cost-benefit analysis do you do? So you say that, look, oil rig in Alaska, oil will be produced, it will create jobs, it will sort of help the economy, and you can make a case for that. What are the cons? That there'll be pollution and there might be other environmental implications. So how will a utilitarian manager who's doing a capital budgeting exercise for these projects, what will he look at? So not only will he look at all the NPV and IRR, he will also try and impact what overall social good is happening, what are the social or environmental issues. So he will try to do a holistic analysis. Same with a deforestation project. You might be creating jobs, but you are hurting the environment in the long run. So what are some of the flaws in this argument? Yeah, the point is that in your analysis and work that you've done at level 2, when you value a company and you project future cash flows, what's one of the biggest issues? It is the subjectivity of your estimates. If it is hard to estimate future growth rates for a company, imagine how hard is it to project the environmental impact of projects such as this. So it's extremely hard to do. That's one issue. What's the other issue with this philosophy? The other issue is that while seeking the greater good, you might violate the rights of a few. So is it okay to totally violate the basic human rights of a few, saying that it is for the greater good? Questionable, right? So these are the two criticisms of the utilitarian philosophy. Next we move to Kant, so a very famous German philosopher. Kantian ethics are based on the philosophy of Immanuel Kant, who argued that people should be treated as ends and never purely as the means to the ends of others. Now, what does this connect with? You've seen this in economics over and over, where your output is based on generally a few factors of production. And what are the most common factors of production? Labor, capital, and others. Now, if you just look at the way people study, there is no difference between labor and capital. So labor is nothing but a means to an end. The end is to produce stuff, and be it people, be it machines, they are treated the same way in classic economic theory. So what is Kant saying? He is saying that you cannot just treat people like cogs in a machine, that they are actually the end, not the means to the end. All right, so people are not instruments like a machine. People have dignity and need to be respected as such. Employing people in sweatshops where they work long hours for low pay in poor work conditions is a violation of ethics according to Kantian philosophy, because it treats people as mere cogs in a machine and not as conscious moral beings that have dignity. Although contemporary moral philosophies tend to view Kant's ethical philosophy as incomplete, for example, his system has no place for moral emotions or sentiments such as sympathy or caring, the notion that people should be respected and treated with dignity still resonates in the modern world. So, from an exam perspective, when we talk about Kantian ethics, there are two broad points. One broad point is that the core theme that people are not to be treated as means to an end, but an end. That's the main thought process. People should be treated with respect. So that's the heart of the philosophy. But the negative is that it's not a full philosophy. It just gives us one guiding principle which we will take and use. All right, next, rights theories. Developed in the 20th century, rights theories recognize that human beings have fundamental rights and privileges. Rights establish a minimum level of morally acceptable behavior. One well-known definition of a fundamental right construes it as something that takes precedence over or trumps a collective good. Thus we might say that the right to free speech is a fundamental right that takes precedence over all but the most compelling collective goals. For example, it overrides the interest of the state in civil harmony or moral consensus. The point here is, in societies, there will be some elements that are defined as these moral truths or these fundamental rights. In a US context, generally free speech is viewed as a fundamental right. Now, those who view free speech as a fundamental right would argue that even though free speech might create problems in a country, if everybody is criticizing the government, might that create unrest and uncertainty? It might, so that is a problem. But if we treat free speech as a fundamental right, then we are saying that because it is a fundamental right, it supersedes the problems that it causes. Moral theories argue that fundamental human rights form the basis for the moral compass managers should navigate by when making decisions that have an ethical component. So if in a given organization the fundamental rights are agreed upon, then those rights can be used as a basis of figuring out what action to take, what action not to take when you are faced with an ethical dilemma. In a business setting, stakeholder theory provides a useful way for managers to frame any discussion of rights. Why? Because you understand your stakeholders, you understand the rights of all the stakeholders, and then you can figure out what needs to be done. As noted earlier, stakeholders have basic rights that should be respected, and it is unethical to violate those rights. Not explicitly mentioned in the curriculum, but I think an issue with this is the definition of fundamental rights. Do you think fundamental rights defined in China are the same as fundamental rights defined in the US? Probably not. So if you have a global company operating across both these countries, how do we define fundamental rights? So anyway, that's a bit of an issue. It is important to note, and we are still on the rights theory, it is important to note that along with rights come obligations. Because we have the right to free speech, we are also obligated to make sure that we respect the free speech of others. Within the framework of a theory of rights, certain people or institutions are obligated to provide benefits or services that secure the rights of others. So the basic point is, if you have rights, then obviously there are obligations. Such obligations also fall upon more than one class of moral agent, and this is a definition you need to know. A moral agent is any person or institution that is capable of moral action, such as a government or a corporation. Now listen to this example carefully. It's an interesting example, and then we need to look at who the moral agents are and what their responsibilities should be. In the late 1980s, to escape the high cost of toxic waste disposal in the West, several firms shipped their waste in bulk to African nations, where it was disposed of at a much lower cost. In 1987, 5 European ships unloaded toxic waste containing dangerous poisons in Nigeria. Workers wearing thongs and shorts unloaded the barrels for $250 a day and placed them in a dirt lot in a residential area. That's scary. They were not told about the contents of the barrels. I don't think that's such a big deal, because if you have a poor Nigerian who has to pay for his food, he's probably not going to think about the long-term consequences, but nevertheless. Who bears the obligation for protecting the safety rights of workers and residents in a case like this? So who are the moral agents? So broadly speaking, there are two moral agents here. One is the government of Nigeria, that is obviously allowing this to happen. The other is the multinational firms. So who bears responsibility? Both. Can the multinational firms say that what we are doing is legal because our government allows us and the Nigerian government allows us, so we can go do this? Obviously, there is a huge moral question here. So the point is that moral agents have, in essence, a moral responsibility to do the right thing. The next theory is the justice theory. Justice theories focus on the attainment of a just distribution of economic goods and services. A just distribution is one that is considered fair and equitable. The most famous theory of justice is attributed to philosopher John Rawls. Rawls argues that all economic goods and services should be distributed equally, except when an unequal distribution would work to everyone's advantage. So bear with me, listen to all this, then we can talk about some scenarios. According to Rawls, valid principles of justice are those in which all persons would agree if they could freely and impartially consider the situation. Impartiality is guaranteed by a concept device that Rawls calls the veil of ignorance, and this is an important term to understand. Under the veil of ignorance, everyone is imagined to be ignorant of all of his or her particular characteristics. For example, his or her race, sex, intelligence, nationality, family background, and special talents. Rawls then asks, what system would people design under a veil of ignorance? Now, before I read the last sentence, all I want to emphasize is that when people design a system, if they design a system keeping in mind their strengths and weaknesses, for example, if you are a cricket team and in Pakistan you build wickets that are spinner friendly, right? You have designed something keeping your strengths and weaknesses in mind. Is that fair? You've created a system that is not fair. But if you create a system with this veil of ignorance where you completely ignore or sort of put on the side any of these factors, then at least the thought process is that you will create a fair system. Now, once you create this fair system and whoever benefits doesn't benefit, that by definition is fair because you created a system that was not biased in any way. So that's the thought process. But this thought process leads to some fundamental items. His answer is that under these conditions, people would unanimously agree on two fundamental principles of justice. So let's see what those fundamental principles are. Now, we don't need to go through that thought process. Here, his philosophy is being compressed in a page, and we just need to understand what those two principles are. The first is that everyone should have the maximum amount of basic liberty. Now, what is that basic liberty that everyone should have? And what he is referring to as basic liberty is the right to vote. So everybody has political representation, freedom of speech, right to hold property, and there are a few more items mentioned, but these are the main ones. So this implies that everything is fair. Now, once equal basic liberty is ensured, so that's point number one, inequality in social goods, income, wealth, opportunity, so these are the social goods, is allowed if it benefits everyone. And then this second principle is taken one step further into what's called the difference principle. Inequalities are justified if they benefit the position of the least advantaged person. So if you do something that creates inequality, let me just make a silly little pictorial representation. So this scale shows how well off people are. This is the worst off people, this is the best off people. If you design a new system where the worst off move up a little and the best off move up a lot, is that a good system? You've increased disparity. But according to the difference principle, this is okay because the people at the bottom have still benefited. Even though disparity has gone up, but at least those at the bottom have gone up a little bit. So if you do something where the worst off benefit, even though the distribution might be unfair, but that's okay according to the difference principle. Now, the point is made that this whole philosophy gives you a mechanism to evaluate ethical dilemmas. The veil of ignorance is a conceptual tool that helps define the moral compass managers can use to navigate through difficult ethical dilemmas. Now let's go back to Nike and the sweatshop, and we can actually relate to this in our country also. Now, if some foreign company comes here and builds a sweatshop where children who are on the streets now at least have a job, not the greatest conditions, but can the case be made that despite the poor conditions in the factory, they are better off there than where they were without the factory? The case can be made, right? So again, it's not black and white. Somebody sitting comfortably in somewhere in the United States, for that person, it might seem like a horrible idea to have child labor. But when you look at the alternative, maybe it's not such a bad idea. So the difference principle actually broadens the perspective and says, look at that. But then, I think this, of all the philosophies, this to me at least seems the most appealing. Then you add to that you try to make rules using the veil of ignorance, rules such that everybody has these basic right to vote, right to speech, these basic rights. So then you work towards building a system that grants this maximum amount of basic liberty to all. So that would then push you in the direction that Nike actually went, where you then try to put in systems where you try to move in this direction. So again, these are moral dilemmas and issues, and things are not black and white, but that's one way of looking at it. Behaving ethically. What then is the best way for managers to ensure that ethical considerations are taken into account? In many cases, there is no easy answer to this question because many of the most vexing ethical problems involve very real dilemmas and suggest no obvious right course of action. Nevertheless, managers can and should do at least 7 things to ensure that basic ethical principles are adhered to and that ethical issues are routinely considered when making business decisions. And I'd encourage you to remember these 7 things. What's the first one? Favor hiring and promoting people with well-grounded sense of personal ethics. This is perhaps the most important. If you hire people who are ethical, then chances are that the organization will act ethically. And how do we do this? We try to look at the past history, look at what they say, what they've done, their reputation. So this perhaps is the most important. Build an organizational culture that places a high value on ethical behavior. Later there is a case on Dell, and they give a nice example of how ethics was built into the culture of the company. So not only do the senior management there talk about ethics, they also practice it. Make sure that leaders within the business not only articulate the rhetoric of ethical behavior, but also act in a manner that is consistent with that rhetoric. So this is a counter to what Kenneth Lay at Enron did, where he talked about being ethical but acted otherwise. Obviously that then defeats the purpose. Number 4, put decision-making processes in place that require people to consider the ethical dimension of business decisions. How can you do that? In your capital budgeting process, you can also have an element that looks at whether this project is ethically sound or not. Hire ethics officers. Many large companies now do this, especially in large accounting firms. You have ethics officers. In fact, my wife is an ethics officer at one of the large firms. And the point is that when there is so much ambiguity in ethical decisions, especially in our line of work and also a lot in the accounting and auditing line of work. So very senior people sometimes have questions about whether so-and-so is ethical or not. Whether it, in our context, there might be a question whether we are complying with the code of conduct. Are we complying with the laws in a given land? And then more importantly, it's conceivable when things are ambiguous, different partners in an organization or different senior managers might have different interpretations. Doesn't it make sense that you have somebody at the center who tries to ensure that there is at least consistency in the way an organization is responding to similar ethical dilemmas? So that becomes an important role in the modern economy or modern business. 6, put strong governance processes in place. We have talked about this at level 1 and level 2 with corporate governance. And act with moral courage. What do you think this means? Moral courage might mean whistleblowing, but the main example given in the curriculum is there are times when clearly acting unethically will benefit you and the organization, and acting ethically doesn't seem right. Acting ethically from a purely financial perspective might not be the best from a purely financial perspective. Still taking the stand and acting ethically, that is being referred to as act with moral courage. And obviously, that would be the right thing to do. All right, now here is the case from Dell. I have skipped the first part, and this is something you can just read through quickly. It is just highlighting the things we've talked about. So these are elements of Dell's code of conduct. They talk about trust, integrity. Not only is it spelled out, but the organization, at least according to what I've read, acts this way. The code goes beyond these general statements, however, to detail what Dell employees cannot do. And this actually is quite important, specifying what you can do and then specifying what you should not be doing. For example, with regard to bribes and gifts, the code states that as Dell employee, you must never accept or give a bribe. The code also prohibits the receipt of any gifts with a nominal value of over $50 that may compromise your judgment. This also might resonate with what you have seen in the code and ethics. But notice a difference here. When we study code and ethics, things are general. Why? Because a company in its context can then specifically say, what does a substantial gift mean? So they have removed all ambiguity by putting their $50 gift limit. Dell has established a global ethics officer, a global ethics council, and regional ethics committees to make sure that the company's ethics policy is enforced. Employees can report ethics violations to the officer and associated committees or via an anonymous ethics hotline. Now this is pretty big. If an employee knows that he can anonymously whistleblow, in a sense, then that is pretty powerful. And what I find really amazing is that this is at a computer company. If this were at a bank or at a large accounting firm, that would be more obvious, but for a large computer company to do something like this is quite impressive. All right, the final words from the curriculum, and then the next slide will be my conclusion. The steps discussed here can help to ensure that when managers make business decisions, they are fully cognizant of the ethical implications and do not violate basic ethical prescripts. At the same time, not all ethical dilemmas have a clean and obvious solution. That is why they are dilemmas. At the end of the day, they are clearly things that a business should not do, and they are things they should do, but there are also actions that present managers with true dilemmas. In these cases, a premium is placed on the ability of managers to make sense out of complex, messy situations and to make balanced decisions that are just as possible. Right? So this is a good way to conclude the reading in the sense that this is not a black and white. So if we have the right moral compass, then we will be making hopefully the best decisions. All right. Now, I can't give my standard advice, which is do the examples, do the practice problems, because the examples are just read-through sort of examples. There are no practice problems. So what do we do? My thought is that here are the most important points that you need to be on top of. Obviously, if you have time, read through this whole reading. I think it's, at least in my opinion, quite interesting. If you don't find it that interesting, you can at least listen to the video and make sure you know these points. The stakeholder analysis, looking through the stakeholders, identifying the most important stakeholders and what they really need and want, that's important. The unique role of stockholders, why is this so important? Because they are the ones that provide the risk capital. Without their funding, or without the funding of stockholders, no company can take off. Recognizing and dealing with the agency problem. Now we know what the agency problem is, and we also know about the sort of corporate governance structures that need to be put in place. What are the underlying causes of unethical behavior? We started this at level 1, and now at level 3 we are building on that list. How do we deal with unethical behavior? We talked about this briefly. For example, if somebody is acting unethically, then you fire those managers. Or more importantly, you try to hire people who are ethical. And then we talked about the different philosophies. The Friedman Doctrine, what was a summary of that? That companies act within the framework of the law and maximize profits for the shareholders, and then let the shareholders decide how to spend their money, what social causes to support, and so on. And then utilitarianism said that we try to maximize the greater good. Kantian ethics said that people should be treated as the end, not as the means. So basically the dignity of the human being, right? But it's not a complete philosophy in the context of what we are talking about. And then we talked about the rights and justice theory. I thought that the justice theory is perhaps the most complete. So make sure you are on top of the justice theory that we just talked about. So at the very least, make sure that all these elements are well covered. All right, so that is it.